Welcome to Buy-to-Let Tax 2, Tax Planning. My name is John Bullock, landlord, investor and accountant, and I'd like to thank you for taking your time out today to watch this video. Do you realise simply by watching this video you're in the top 10% of all landlords that take the time out to educate themselves with regard to their property portfolio? Over these 3 videos, which will last approximately 10 minutes, I'll introduce strategies to protect your wealth as an income tax paying landlord and introduce you strategies to increase and grow your wealth. In Buy-to-Let Tax 1, I spoke about the journey I took with regards to making discovery on the solutions that were there available for income tax payers that held property as a portfolio. In particular, I made the statement that there used to be a saying, safe as houses, and really now the saying should be safe as houses dependent on the business structure you use. And I want to look more at the business structures now and the options you have as a landlord. Choice 1 is quite an obvious one. Sell up now, don't prevaricate, and wait until your tax bill comes in January 19. Because in my opinion, once people get their first tax bill, they'll realise something is wrong. And they will be instructed by their accountant to likely sell the property because they're losing money on it. And at that point in time, there will be likely between January 19 and April 19 a glut of properties coming onto the market. Now, if you want a free valuation today, a slide will come on immediately now, and it'll give you, if you can copy down that link, we can give you a free valuation, a best valuation on your property today with a view to help you sell it. Second solution is you can elect to do nothing. And I think people aren't making a conscious decision to do nothing. I think they're so scared of making a mistake that they'd rather do nothing than make the mistake and make the consequences for that mistake. So it's not a positive thing that's being done. It's actually being done because they're scared. It's just they think they can't do right for doing wrong. And that's why, from their perspective, it's better to do nothing. The third option is the option that I hear mooted about by many accountants. And it's incorporation, and that's because corporations are not hit with the restriction on mortgage interest relief. In other words, you can still count that as a deduction, whereas income taxpayers will not be able to do so. So at face value, it seems like an ideal solution. But when you move your properties from an income tax paying position to a corporation tax paying position, you automatically trigger capital gains tax and stamp duty land tax. Capital gains tax is the difference between when you sell the property and what you actually bought it for. And if that difference was £20,000, then you would pay gains on your £20,000 after deductions that you were able to make. Of course, there's the stamp duty land tax as well, which is paid at 3% now as a premium for owning a second home. As well as the increased taxes that will come about with regards to capital gains tax and stamp duty land tax, once you find your property is incorporated, you will pay corporation tax, and when you take the money, you will pay income tax. So you have a double taxation hit. And then you will also find that your mortgages or cost of running your business is more expensive, because commercial mortgages are more expensive than buy-to-let properties for income taxpayers. But more importantly, and for me the greatest risk in all of this, is the fact that nothing's preventing the government from changing the treatment of interest relief for corporation taxpayers. And that for me is the greatest risk. You could have all the cost of the stamp duty land tax, capital gains tax, the increased mortgage cost, the double taxation, only to find that the government then changes its mind for the treatment of interest relief for corporations. And that for me is a great risk, besides the risk of the increased cost. Now the fourth option, again mooted by many accountants, is a thing what we call rollover relief. So going back to the earlier example where we had a 20% gain, if we had one share within the property, what we would do is we'd roll over that gain into the value of shares. So one share would be valued at £20,000. Again, you have all the limitations, all the downsides I spoke about earlier. The cost of mortgages are higher, you have the double taxation, and of course there's nothing preventing the government from changing the position for corporation taxpayers. So the risk is still real from that perspective. But there's an additional risk, because once you claim incorporation relief, you've had to pass certain tests. And I think HMRC will look at these, the way you've applied these tests, they will scrutinise and analyse and decide whether you really do qualify. I can see many landlords and many investors having to jump through many hoops with HMRC to try and validate their claim for incorporation relief. Now there's also another 4B solution, because as well as mitigating your capital gains tax position, there still remains the problem with regards to your stamp duty land tax position. But there's a mechanism being employed whereby you have a temporary solution, and for 3 years you produce partnership accounts. So you have this transition period. You move from income taxpayer, partnership for 3 years, and then roll over into your limited company. If you follow that procedure, and again I advise you to take professional guidance in this particular matter, but essentially if you follow this, you should mitigate your position for capital gains tax and stamp duty land tax, depending on you qualify on certain aspects to be able to claim those reliefs. And if you don't, it will be challenged. And one of the obvious challenges is that many people will turn around and say, well, the gains weren't that great. I have to say, even though you own the property as an income taxpayer and then as a corporate entity, the value of the disposal of the sale is always perceived to be at market value. And that's one of the tests that they will look for, to make sure that when you crunch your numbers, you've done it correctly. For me, those risks were far too great. I didn't like the menu that was put in front of me. For me, the thought of doing it and all those additional costs, the double taxation, and the thought of maybe and more than likely being challenged with 1 or 2 points made the risk too great. I didn't like the menu. So there is a fifth, and the fifth is the hybrid solution, the solution that I am highly recommending. And I'm recommending it because it's not temporary. It is a permanent solution. It is the hybrid solution. When you move to this solution, it's not disclosable under the tax avoidance schemes. In other words, I'm not doing it as a temporary measure to benefit from not attaching to a tax. I'm doing it as a permanent basis, as a basis to grow my wealth. What's also absolutely fantastic about this type of entity, the hybrid solution, it is an artificial personality, but what's great about it is that it's taxed like a partnership, but it's all in some respects treated like a corporate entity, but without all the transfer rules with regards to the stamp duty land tax and capital gains tax. They're not as rigorously applied with regards to the hybrid solution. And it is because of the significant reduction in risk with regards to the transfer and many other benefits that I will talk about in Buy-to-Let Tax 3 that I'm highly recommending this as a solution. Thank you for watching Buy to Let Tax 2.